Cost segregation made simple by the Green Capitalista. If cost segregation is new to you, then chances are you're probably like thousands of commercial property owners that are overpaying their taxes simply because they're not aware of this tax ruling that is actually in our favor. The traditional straight line method of accounting will depreciate an apartment building over a 27.5-year period and a commercial building over a 39-year period. Cost segregation is an engineer-based accounting method that is IRS approved and recommended. You must perform an engineer-based study in order to utilize its benefits. Cost segregation first identifies and then separates the real estate into 4 categories: personal property, land improvements, building, and land. Personal property and land improvements are then depreciated at an accelerated rate of either 5, 7, or 15 years. Personal property can include items such as qualified floor coverings, decorative lighting fixtures, and electrical or plumbing equipment that is dedicated to specialty equipment. Land improvements would include items such as sidewalks, fencing, and even landscaping. What this does is reduce the amount of tax liability, which will increase the amount of cash flow the property produces each year. Each $100,000 in asset reclassification from a 39-year recovery period to a 5-year recovery period results in approximately $16,000 in savings. Take a property now with a value of $1 million. You would simply multiply $16,000 by 10, which would equal $160,000 in savings for the first year alone. Here's an example based on an actual case study. Here's Patty. Patty just purchased a building to run her business called Patty Cakes. You guessed it, selling the most delicious cakes and using her grandmother's famous recipes. Historically, purchasing a commercial building requires a large upfront investment that depreciated very slowly over time. Uncle Sam essentially had a lock on the building, returning Patty's money to her, the property owner, bit by bit for the next 39 years. Recent IRS rulings have allowed huge portions of the building's asset to essentially be unlocked. By segregating or separating the cost from Patty's personal property to real property, up to 40% of her building's asset can be reclassified and depreciated at an accelerated rate. Patty is feeling pretty happy right now for having a cost segregation study performed for her new building. She is now going to be paying less on her quarterly estimated tax payments, which will free up her cash flow to make improvements to her business, such as a remodel, expansion, or restoration. These new improvements that were made are also eligible for another cost segregation study as well. If you have purchased, constructed, renovated, or expanded commercial property since 1987, or even own lease-hold improvements, you may qualify for a cost segregation. Even if you're operating at a loss, you may qualify for a refund of taxes you paid in the past. The Green Capitalista is happy to provide further information in a more detailed report. Just click on the free report button below on the page and get your copy of the report today. We also recommend using a cost segregation specialist to ensure that your study is done properly and documented well to support and withstand IRS scrutiny. Not all cost segregation providers are created equal. Make sure you receive an engineer-based study, which is recommended by the IRS in their Audit Techniques Guide. The third party will work together with your CPA to maximize the full benefits that can be derived from the study. If you would like to be connected to our preferred cost segregation provider, click on the little green book and look up Cost Segregation Services. They are certified in all 50 states and are happy to answer any questions you may have to see if cost segregation is right for your business or commercial property. That's all for now. I hope you enjoyed the information, and cheers to you and your success.